Thanks, Jared and Ran, for having our paper on this program. We're very happy to have the opportunity to present the paper here. And again, this is a joint work with Phil Strong of Boston College and NBER. And since I'm with the Fed, the standard disclaimer apply. This is our view, not necessarily the view of the Federal Reserve. So very quickly and briefly, so what are we doing in this paper? So we have 3 research questions, and here are the answers. So the first one is, who actually supplied the PPP loan last year in 2020, the first 2 rounds? You can simply answer this question by looking at the aggregate data. If you look at the aggregate lending by different type of institutions, banks are, with no doubt, supply the vast majority of the PPP loan. Over 75% of the loans are originated by banks. And probably a more interesting question is about which banks actually supply more of the PPP loans. Our answer to this question is relationship banks that have a long-term interest in the survival of their clients, of their borrowers, relationship borrowers. So we've tried multiple proxies for relationship banks. We have looked at small banks, banks with more loan commitment, C&I loan commitment, commercial industrial loan commitment, and also banks with more small business lending, and also bank with more local core deposits. All those measures or proxies point to the same direction. So relationship bank supply more of the PPP loan last year in the height of the crisis. So naturally, we want to ask, does it matter? So this answer is a bit of a mixed answer. So the answer is yes, in the sense that relationship lender, they got the money out faster to their relationship borrowers in the first round of PPP. That does lead to lower local county level unemployment rates. However, that reduction in the unemployment rate is actually pretty small relative to the actual increase, overall increase in the unemployment across the economy. So what are the takeaway or implications from our study? So we want to argue there is a new reason for the benefit of having banking relationship, especially during crisis. So there's been a long literature, a very rich literature on banking relationship. Most people believe that banking relationship is a good thing in certain cases. So the focus of those studies mostly are on the information asymmetry, staff information, and credit risk. So for a bank, know their clients for a long time. They know how, what's the credit risk, the actual intrinsic credit risk of the borrower. They can help them throughout the different economic cycles. Here we have the PPP, which has little or no credit risk. So we want to argue there's a new reason for having a relationship banking during crisis. That is, the banks can help you access the government subsidy. So we've seen this multiple times. In 1998 with the LTCM crisis, in 2008 with the multiple programs targeted at banks, including TARP, and also in 2020 with the PPP and other programs. So the government have a pattern of trying to intervene or distribute the subsidy into the economy, to the end users, to the borrowers, through the banking system. There could be pros and cons for this approach, but as given that fact, we want to argue there's a new reason for benefit of having banking relationship, especially during the crisis. And also, we also have some finding about the very little stimulus provided by PPP, which is, in our view, consistent with other papers on PPP. Here, we want to be a little bit more careful on that. So we have a huge caveat here. We only compare the unemployment pattern between counties, based upon whether they have PPP loan in the first round. So we do not intend to evaluate the effectiveness of the PPP itself. Like we don't have an answer to if the PPP is effective on the economy overall. That's beyond the scope of this paper. We simply use this, like PPP provide very little stimulus on the unemployment rate for counties with more PPP loan in the first round as evidence, further evidence that relationship lending during crisis matters. Okay, so let me move on. So I hope by now the PPP program has been here for over a year. People are more familiar with that than a year ago. So the PPP program and PPP loans are government-backed loans. They're administered by SBA. The first round of PPP started in April of last year, April 3rd to begin with. The first round, $350 billion, met huge demand. They exhausted the funding in first 2 weeks. That additional funding of $320 billion was approved in about 10 days. So the funding started to flow again after April 27th. So this is a chart about the total daily PPP lending amount. So the first wave or first round happened in the 2 weeks of April. then you have a 10-day gap. Then you have the second wave. Pretty much by the end of May, the PPP lending of last year has mostly reduced to a single-digit lending. So the PPP program, the loans have the same term, regardless of the credit risk profile of the borrower. They have a 1% interest rate, 2-year or 5-year maturity. It's forgivable if the borrower met certain conditions. And you can borrow up to 125% of the 2-month payroll and capped at $10 million. The funding are from the lenders. Started with all the depository institutions, banks and credit unions, then later expanded to include non-bank lenders like fintechs. And there's no fee for the credit guarantee. Also, all the PPP loans are guaranteed by SBA, and banks do not need to pay anything for that credit guarantee. So what are the special or uniqueness for the PPP loan relative to like ordinary loans made by banks? First of all, it doesn't have any credit risk. All the loans are guaranteed by US government. Banks, from the lender perspective, they don't expose themselves to any credit risk from lending PPP loans. There are also very minimal funding and capital constraints. So you can get funding from the Federal Reserve's PPP LF if you're a bank, or later fintech as well. And also, those loans are risk-free from the capital regulation perspective. That wouldn't affect your capital ratio mostly. So what are the main costs or frictions for banks to make those loans, originate those loans? So to begin with, especially in the first round of PPP, very early in the program, banks need to certify the borrowers eligible with a lot of like criteria for doing that. And also they may help borrowers with some paperwork. So it's more like the lender, the bank, have to have some manpower to help their borrowers to go through this paperwork, the procedure. It's not about the credit risk, not about the liquidity constraint, not about the capital constraint, which are usually the factors that affect bank lending in normal times or even in previous crises. So we are going to, before we actually got into the bank level or county level regressions, the analysis, let's look at the aggregate landing in the first two quarters of 2020. That actually have some very interesting patterns. So this is I like this chart a lot. So this shows the cumulative CNI, the commercial industrial lending by bank size, large banks versus small banks since the beginning of 2020. So they start with the very slow growth, which is okay, fine, regular. And starting from the second week of March, the lending by large banks, which is the yellow blue line, sorry, the not so dark blue line here, that shoot up greatly. In the last 3 weeks of March, for those 3 weeks, average lending growth at large banks is 6% per week. That's about 50 times the average going back to 1973. So this is extraordinary and unprecedented. And those increases in lending are pretty much driven by the clients of large banks, large firms. They're drawing down their credit lines with the large banks. Then so small bank lending also increased, probably for similar reasons, or for their clients, ration for debt, dash for cash. Starting at the beginning of April, the small bank lending increased super dramatically. And again, that's related to PPP. So PPP kicked in on April 3rd. This is roughly the time when the lending by small banks increased. And they stabilized or decreased a little bit after the PPP money went out or was used up. For large banks, the lending actually declined after the second quarter of last year, partially because their clients, large firms, they regain access to the capital market, like bond market, and they start to pay back some of the credit line drawdowns from their banks. So that's the pattern for CNI lending for small versus large banks in the first quarter of last year. And also, so I mentioned that small banks, they have their interest in their long-term survival of their clients, but they also have some profitability, like increasing the profitability in lending PPP loans or originate PPP loans. This chart basically is a scatter plot. So on the x-axis, we have the PPP loans in the first quarter and in the second quarter of last year, scaled by the assets as of 2019, like the year end 2019. The y-axis, we have the change in net income year over year, scaled by the 2019 assets. It's a straight line for small banks. This is the banks less than $10 billion in assets. It's almost a straight line. If you lend more PPP loan, you have a bigger boost in the profitability. Similar thing apply to the non-interest income, like fee income. If you, as a small bank, you lend more PPP in the second quarter of last year, you got a boost in the non-interest income or fee income. So it's a good thing for banks from the profitability perspective to originate the PPP loans. Okay, so talking about the tests, the empirical results, we actually run two sets of results, one at the bank level, one at the aggregate level. So for the bank test, we'll look at the cross-sectional effect of bank lending and also the effect of bank characteristic on lending. So we go several layers. We start from the very aggregate level, then go deeper and deeper. So we first start with the lending characteristics of banks, comparing the first quarter versus second quarter. So there's a huge difference between the lending pattern for large firms, large banks versus small banks. Then within the second quarter, we'll look at lending under the PPP program versus those non-PPP lending. Then within the PPP lending, we'll look at bank lending in their core markets, meaning bank has a branch in the county, versus peripheral market, where the bank does not have any branch. So within the same bank, we compare the lending in their core versus peripheral market, both under PPP. Then within the core market, where the bank has a branch, we look at, does the bank lend more into certain core markets based upon the characteristics of the market, like the bank have more market share in the market, in the core market, or the bank have a long-term relationship, meaning the bank have an older branch in there. Their branch has a long time in existence in the core market. At the aggregate level, we have two different tests. The first one at the county level, we simply look at the relationship between the PPP lending and local banking structure. And also then at the county time level, like county day or county week level or county monthly level, we'll look at the change in unemployment and consumption and small business revenue as a function of the PPP lending. So that's the roadmap. So the data come from the very standard sources, bank data from the summary deposits and core reports, the lending from the core reports, and also we use the SBA PPP loan data set. And we merge SBA PPP lending, PPP data set with the core report. We got over 4,000 banks, 4,300 banks. And that's out of the roughly 5,000 banks in the core reports. And those banks cover over 95% of the PPP loans. So we're fairly confident those banks cover vast majority of the lending in the PPP data, in SBA PPP data. All right. So this is a very first, like almost univariate comparison. So we look at the PPP lending as a share of assets by bank size. We have the large banks greater than $50 billion, and medium-sized banks $10 to $50 billion, and small banks less than $10 billion. So as a share of the assets, this assets as of last year, as of year 2019, the year before last year. So the large banks lend 2.1% of the assets out under the PPP program. The smaller banks, the medium-sized and the small banks, their share of assets under PPP program is double that number. It's 5.8 or 5.5%. And again, this is consistent with other people like Ranjay et al. In their paper. Basically, the large banks like punch underweight in the PPP lending. Okay, so this is the first task we're running. We compare the lending characteristics of banks in this first and second quarter. So as we mentioned earlier, the first quarter lending is driven, or increase in the lending in the first quarter of 2020 is driven by large firms drawing down their credit line from large banks. And second quarter, we argue that's pretty much driven by PPP. And also PPP was mainly by small banks. So if you look at the coefficient for the first two columns, the first column is changing loans, on-balance sheet loans. Is positively correlated with the end-use commitment as of the year-end 2019. But the change in total credit, which is the on-balance sheet loan plus end-use commitment, that number is unresponsive or irresponsive to any of the variables here. So basically the banks or the borrowers are drawing down the lines. Those lines from end-use status change into on-balance sheet loans. That does not change, that does not affect the total credit supplied by the bank. In the second quarter, the story is very different. So again, the change in C&I loans is positive on end-use commitment and also on the core deposits and also on negatively to the bank size. And also if you compare the size of the coefficient, in the first quarter, the coefficient on the end use commitment is 0.06. In the second quarter, the number is 7 times larger. So it's driven by small banks, and it's, well, it's huge in terms of magnitude. And again, in the second quarter, if you compare the change in total credit supply, which is the on-balance sheet loan plus end-use commitment, it's again very positive on the previous last year or 2019 year-end end-use commitment and also non-core deposits. Those are all the variables we try to use to proxy for the relationship lending. They all load positively on loan growth. Then let's zoom in on the Q2 2020. We split the 2020 increase in lending into the non-PPP lending, the first column, and also changing non-PPP lending, non-PPP credit, which taking into account the end-use commitment, and lastly, the PPP lending. So we have little or nothing in the first two columns. Those increase in lending of non-PPP lending or non-PPP credit have little to do with the relationship variables we list here. The PPP loans are highly positively or significantly related to the lending to the relationship variables. And again, small banks lend more of those. Then let's focus on the PPP loans themselves and split by bank size. So we have large banks of greater than 50 billion, medium size 10 to 50 billion, and small banks less than 10 billion. The relationship between the relationship variables like core deposits, small business loan lending as of 2019, keep saying last year, but that's a year ago, 2 years ago. It's positive and significant mostly for medium sized and small banks, not so much for large banks. In other words, in the second quarter, small banks and medium sized banks, they originate more PPP loan as shared assets, and the more relationship borrower they have, or the more relationship lending they are, well, the more relationship lending they have, the more PPP loan they originate. Then we turn to, this is a bank level analysis. We split the lending by PPP by banks into core markets or core counties where the bank have a branch versus a peripheral one where the bank does not have any branch. So every bank has one observation. So we aggregate PPP lending by a bank into core markets lending and peripheral market lending, both scaled by assets as of 2019. And again, here we have the three relationship variables: end use commitment, C&I, the small business lending, and core deposits. They all load positively for the core markets, meaning in the core markets where the bank have a branch, the bank lending, while the relationship variables is highly predictive of bank lending. In the peripheral market where the bank does not have a branch, that's not the case. And the difference between the two are all significant. The difference between the core market and peripheral market are all significant. In other words, when we say the banks originate more loans, if they're a relationship lending bank, if they're a relationship bank, that's true or more true for their core markets where they have a branch. It's less so for peripheral market when they do not have a branch. And in the very last step of our analysis, we're going to use the core market, or sometimes we can say for the local market. We use this model to predict the PPP lending by a local bank in a county. And we use that as an instrument to evaluate the benefit of PPP loan on local economy, on employment, and so on and so forth. Okay, so then we try to look at within the core market for a given bank. Does the bank lend more in certain core market versus others? So we have the log lending on the left-hand side. On the right-hand side, we have several measures of how important the county is to the bank. So we have the percent of bank deposit from the county and percent of the county deposit held by the bank, and also the branch age. It's a deposit weighted average branch age for all branches in a county. So what we find here is within core markets. So bank has a branch in all those counties. Bank lend more if in that county if they held more deposit from the county, and if the bank has some branches that are in existence for a longer time, the age of the branch is older. And all those are economically and statistically significant. So let me move to the county level analysis. So we aggregate the PPP lending to the county level. The analysis, we try to use analysis to create an instrument for PPP supply. So we try to identify the supply effect of PPP from the bank lending, not really from the demand effect on PPP. So we come up with the idea of using the weighted average of the predict PPP lending by local banks. Recall that local bank lending is the relationship of variables like core deposits, C&I lending, and also end-use commitment. Those are highly predictive of lending by local banks, banks with branch in the county. So we try to use those pre-existing banking structure in the county to predict the lending by local banks in the county. So I'm skipping the results from that county level analysis. Basically, we find that for county with more local bank predict lending, for county with more local banks with longer relationship, with better relationship, they do got more PPP supply in the first round of PPP. So given that, using that predicted PPP lending, we put that into a regression. On the left-hand side, we have the economic outcome like employment or unemployment and the consumer spending and also small business revenue. We have a host of interaction of this predicted PPP lending at county level, interaction with monthly indicators like March, April, May, June, and July. And also we control for a host of demographic and economic controls like the population with college education, medium income, and employment rate last year, so on and so forth. And also we have the state time fixed effect and county fixed effect. So we focus on the interaction term, which will be identified from an interaction of the county characteristics with the calendar month indicator. So here are the results. So we run a regression of the small business revenue, total consumer spending, and unemployment rate. We have March here, which we think is a good placebo test. March is pretty much a crisis month, but we do not have PPP there yet. So for the small business revenue and total spending, we have almost nothing, no results here. We do have some statistically significant results for the unemployment. So for a county with more predict PPP lending, that's again from the local banking structure, they do have a reduction in the unemployment rate increase in May, June, and July. We don't have that in March, which we take again. This is a good placebo test. But unfortunately, the economic magnitude of those coefficients are fairly small. So for instance, for one standard deviation increase in the PPP lending, predict PPP lending, that's related to only 0.21 percentage point decrease in unemployment rate in June of last year. Relative to the overall unemployment rate increase about 7%, 8%, this is a fraction of that. This is very small. All right, so to conclude, we want to argue that relationship banks, they supply more PPP credit than other banks during the crisis in the first two rounds of PPP. And we argue that that's a good reason for firms, borrowers, to have access to banks or relationship banks during crisis, as access to government subsidy usually goes through the banking system. And also county with more relationship banks, they receive more supply of PPP in the very first round, and that leads to a lower unemployment rate. However, that has a limited spillover to consumer spending and or small business revenue, and the magnitude of that positive impact of PPP lending is actually small. And thanks. I'm looking forward to your comments or questions.